What's up, everybody? Before we get started, I just want to thank everyone who's found my channel this year. I started posting regularly on YouTube about 7 months ago, and we're pretty close to about 7,000 subscribers right now. So thank you so much to everyone who's found the channel, who's followed, who's supported, who's left comments. I really appreciate it. It's been a fantastic year for us in the market. I'll have a few videos coming out soon on my biggest winners this year and also my biggest losers. You could call them maybe my biggest mistakes as well. But I figured today we would look forward to 2026. And I'm going to give you 3 sectors that I see potentially being undervalued going into 2026. The market overall looks quite expensive. We talked about it a number of times on the channel. We're close to all-time highs. There's a number of sectors where you look at the price relative to the fundamentals, and I'm not saying it's necessarily a bubble, but the market looks expensive. Valuations are rich. With that said, I still feel like I'm able to find opportunities in the market, and there are certainly 3 sectors in particular where I've been putting most of my capital recently. So that's what we're going to talk about today. As always, if you get value out of the video, subscribe to the channel. If you want to support what I do, get access to the website I'm building out here, as well as my templates and Google Sheet add-on that I use to make these sheets that you see here, then consider following me on Patreon. Link to that will be down below. Now, let's get into it. And the first sector is probably not going to be a big surprise to people who have followed the channel, but it is healthcare. I have positions in Elevance, UNH, Centene, Molina. Collectively, this is a decently sized bet for me. And we started talking about these companies back in July. We are up on all these companies from the point that we were buying in, but I'm not planning on selling any of these stocks right now. I see quite a bit more upside. These companies are still trading for relatively cheap valuations. For pretty much all of these health insurance names, they have fallen so much throughout the year. Elevance, for example, down close to 40% over the past year. But the story, when you look at the financials for all these companies, they all tell a similar story. Top line revenue has been great. You look over 20 years, 5 years, whatever time period you want to look at, top line revenue has been growing quite well. Demand for healthcare is there. The issue with all these companies has been the margin. If I throw operating margin onto this graph, we see margins have been down. Again, it's a similar story regardless of which company we look at. Let me just search for Molina here. If we look at their financials, we see, top line revenue growing very strongly. Let's add operating margin onto this graph, and we see, margins have been falling down. This company used to have margins in 4 or 5% range. Now, right around 2.5% operating margin over the past 12 months. If you want a specific look at any one of these businesses, you can search on my channel. I have videos that I've done on Molina, on Elevance, on many other companies in the sector. But the bottom line is that costs for healthcare have been way higher this year than any of these companies anticipated. As you see, all of these businesses are operating with single-digit operating margins, razor-thin margins in the sector. If costs come in a bit higher than you think, your profit can disappear very quickly. The question is, do you think we are in a new normal of just structurally lower margins across all these companies? Or do you think that these companies are going to reprice their plans to get back to somewhat normalized margins? Listening to all the conference calls of these companies and seeing what's going on in rates across Medicaid, Medicare, Marketplace, all these little subsegments in health insurance, it's my opinion that rates will normalize, and it might take a few rate cycles for that to happen. So I don't expect that 2026 margins will, be right back to where they were in, say, 2023, but I think we are likely at the low in earnings. And if rates normalize, these companies simply look extremely cheap. I'm going to pull up my spreadsheet for Molina here. The price has gone up since we last looked at it, so let me just update the price. And in just a moment, there we go. This is the most up-to-date price. Looking at my base case assumptions, I was assuming 5% growth every year for 5 years on the top line. They recover to 4% operating margins. Some money is coming back to shareholders. That will likely be in the form of buybacks. Recently, they've actually been very aggressive about buybacks while the stock price has been down. And I'm just giving this company an 8 times multiple on operating income. I think these are reasonable assumptions for my base case. I don't think I've assumed anything too heroic here. And if these assumptions come true, you're looking at a 22% annualized return on Molina stock, which is about 170% gain over 5 years, getting close to a triple on your money over that time. Now, there is risk here. Molina is quite exposed to Medicaid. That's about 90% of their premiums. And there are some questions about, what's going to happen to Medicaid eligibility under the Big Beautiful Bill. I encourage you to go to my channel and look at my video on Molina if you're interested about this particular name. Medicaid rates are going up more than 5% year over year. So, assuming 5% growth on the top line is actually assuming a slight decrease in membership. But as you see from my model, if you think that rates are going to normalize, this company is simply too cheap. Of the stocks in this sector, I consider Elevance and UNH to be higher quality. They're more diversified. They're much bigger players. They also have large health services arms. UNH has Optum. Elevance has Carelon. This potentially could lower the risk, but I have to say, looking at the current prices, I think that the risk reward on Molina is among the best of the health insurance companies right now. Elevance, UNH, and Centene, which is another company that I own in this sector, all of their stock prices have jumped a decent amount off the lows and from where we were buying back in July. Molina is the one that I've been adding money to over the past month or two. With that said, I still like the whole sector. I have no plans to sell any of these stocks anytime soon. I also think if we have a recession, if we have a slowdown, healthcare may hold up better than the rest of the market. Now, let's move on to the second sector that I think is undervalued right now and possibly set up for outperformance in 2026. And just before we go on, none of this is advice to buy or sell any of the stocks that we're talking about here. I'm just giving you my opinion and I tell you what I'm doing with my money. And the second sector that I'm interested in that I think is undervalued is energy. The energy sector is unloved, it's boring, it is hated by some people, but many energy companies on a cash flow basis are extremely cheap. Now, energy is a very broad category. You have natural gas stocks, you have coal stocks, you have oil stocks, and within any of those buckets, you could divide them further. Within oil, you have the big diversified players, companies like Exxon. But oil can be broadly broken down into upstream, midstream, and downstream. Upstream is, you're exploring for the oil and you're getting the oil out of the ground. Midstream is you're transporting that crude oil from out of the ground to refiners or to somewhere else. Downstream oil companies are the ones who are actually refining the product into gasoline or jet fuel, and they're often marketing them. They're dealing with the end consumer. These are companies like, Marathon Petroleum. That would be one example, MPC. Now, for me, I've been looking at a lot of these small upstream producers. I find that there is a lot of value there. A ton of these companies are overlooked. I recently did a video talking about PetroTal. This is a company that has sold off a massive amount recently because they suspended their dividend. And, suspending your dividend, that's never fun for people. But this is a company with a net cash position that is sitting on an absolutely massive amount of oil reserves in Peru. They've been extremely well run and they are trading for just a dirt cheap multiple. Whether you want to look at enterprise value to cash flow, whether you want to look at enterprise value to barrel of flowing oil, to reserve value, whatever metric you pretty much want to look at here, this company's dirt cheap. And full disclosure, I own it. I owned it before this drop and I've been buying more since the company went down. There are other names, other companies like this that are simply very cheap right now. No one wants to buy these stocks. And part of that is because oil is cheap right now. I mean, we're right at $60 a barrel on Brent. Adjusted for inflation, this is really not a high price that we're at today, but everyone is afraid of an oversupply in the oil market. And yes, it is likely that there is going to be a temporary oversupply in the oil market in the beginning of 2026. Is that going to push oil prices even lower? Maybe. Predicting short-term movements in the price of oil is like predicting short-term movements in the price of a stock. There are analysts who dedicate their life to this, and frankly, I don't think anyone can consistently, accurately predict short-term movements in the price of oil. It just can't be done. Will oil be $50, $40 a barrel next year? Will it be $100? I don't know. Any one of those could be the right answer. What I do think is that at $60 a barrel oil, you're not going to have much additional growth in production. Companies are not going to aggressively drill wells at $60 oil. Could we still have an oversupply in 2026? And could that drive the price of oil down lower? Yes, it certainly could. But at low prices, at some point, you're going to have an issue with supply. This industry is cyclical for a reason. The cure for low prices is low prices, because inevitably that's going to lead to lower supply. Oil demand is not abating anytime soon. Oil demand is pretty much just going up. I think in 5 years, the chance that oil is at 100 is higher than the chance that oil is at 50. I don't think anyone is really positioned for a world where oil is back in the $80 to $100 range. And if we get there, a lot of these small upstream producers, they're simply way too cheap. And while upstream has been my focus, it's not the only area of energy that I think looks interesting. I think the drillers look interesting, companies like Precision Drilling and also Ensign Energy. These businesses have been aggressively paying down debt. They are hugely cash flow positive. The offshore oil space, companies like Valaris and Seadrill, Noble, Transocean, ticker symbol RIG is also in there. I don't own any offshore oil companies. It is a sector I've been looking at. The cash flow for these businesses does look good. Rates for their drill ships have been going up. I even think coal looks interesting. That's a sector that maybe we will dive more into in the future. But the bottom line is energy demand is only going up. We are going to consume more and more energy in one form or another. And as much as we would like that to come from renewable sources, green energy as it's called, most of the energy demand is for strong baseload power. And the options for that are really nuclear or hydrocarbons, which is oil, natural gas, and coal. A lot of companies in the sector have very strong cash flow, and we're not even really in a high price environment for these commodities right now. If oil prices do come under more pressure and we see Brent fall, down to the $50 range next year, I will likely be buying aggressively in the space. It's possible that a slowdown in economic activity and lower oil prices will lead to a lot of these names to sell off a ton. That's what happened in April of this year, and in spite of the fact that oil is at its 52-week low, some of these companies just got silly cheap back in April and May, and we were able to pick up dirt cheap upstream names like Baytex, a name that, yes, people hate. Baytex is like the Kohl's of oil companies. You tell an oil investor you bought Baytex, and they say, really? Baytex? You own Baytex? And yes, I bought Baytex. This company has been close to a double for us. Again, in spite of the fact that oil is down over this time, that's just how silly cheap these companies can get. Now, moving on to the third and final sector that I think is cheap, and it is payment processors. I've talked recently about PayPal and Fiserv and also a bunch of the other merchant acquirer companies like Block, Square, Shift4. Most of these names have sold off a lot. PayPal right now, under $60 a share. This is a company that I've been buying recently. I've owned PayPal actually for quite some time. I bought it back at about $55 a share. And yeah, that ran up all the way to $90. I wish I sold then. I didn't. I've simply held my PayPal shares. Now with PayPal back at $60, I think it looks like a better deal today than when I was buying it at $55 a couple years ago. The enterprise value, just 10 times operating income and 8% adjusted free cash flow yield. I always look at adjusted free cash flow, which to me, I define adjusted free cash flow as free cash flow when I account for the share-based compensation that a company is paying out. That's a real expense. A lot of people don't take it into account. PayPal does pay quite a bit in share-based compensation, but even when you account for that, they have an 8% free cash flow yield. That's excellent, even with no change in sentiment, no multiple expansion. I could expect to earn 8% in the adjusted free cash flow yield, which they're returning to us aggressively in the form of buybacks, and probably mid-single digits on the top line. I think I can get a market-beating return on PayPal with no expansion to the multiple, no change in the market sentiment towards this company. Now, if we do have a re-rating in the multiple, I'll go over to my PayPal spreadsheet here. We'll look at my base case. I'm assuming 6% growth on the top line. I think they can hit that. Operating margin, I'm just assuming they basically stay where they are at 18%. This is the money coming back to us in the form of buybacks. And if I give them a 14 times multiple, which honestly I think is fair for a company of PayPal's quality, mid-single digit growth, very reasonable debt, decent margins, I don't think that this is a demanding multiple. And you're looking at a 21% annualized return in this case. That's a fantastic return, even in my bear scenario where I'm assuming that revenue growth on the top line slows to 3%. This is basically just no real growth. They grow in line with inflations. Margins pull back slightly. And I'm just keeping their multiple right where it is at a 10 times multiple on operating income. I'm looking at an 8% annualized return on this stock. For a bear case, this is absolutely fantastic. I think the risk reward on PayPal is great today. Fiserv also, I did a video on this recently. I think the risk reward is excellent here. We started buying around $65 a share. I've been adding to my position in the 60s. This isn't a deep dive. There are issues with this company. Management previously was a bit of a train wreck. Again, you can check out my video on Fiserv, but I think that they're simply too cheap. I think the risk reward today is quite good. But in fact, I actually think this whole sector is quite cheap. Global Payments looks very reasonable. Shift4, another company that we looked at. Maybe I'll do another deep dive into this one. Price has been coming down. It's starting to look even more interesting. I'm a bit concerned with how much of their growth has been through acquisitions. They've taken on a decent amount of debt to do that. But with that said, they have a decent adjusted free cash flow yield. This is a company that has only recently started to flip into operating profitability. So you might look at the multiples and say, Shift4, it doesn't really look that cheap. These multiples aren't that low, 30 times enterprise value to operating income. But you have to understand that when you just flip into profitability, as these margins improve, that multiple can come down quite quick. So I think this company looks interesting. I think the sector looks interesting. If you want to look internationally at payment processors as well, I think there's a number of interesting options. We talked about StoneCo not too long ago because it is a pretty decently sized holding in my portfolio. One thing to be aware of is all these payment processors are tied to the general economy. If there's concerns about the consumer, about macroeconomics, about just spending in general, yeah, that could hurt the bottom line of all these companies. That is something that I'm thinking about. Euronet, by the way, another company we looked at not too long ago. I think it looks very interesting. And yeah, just in general, looking at all these companies, I think that this sector looks cheap. So I think we'll wrap it up there for today. Those are 3 sectors I think look interesting for 2026 in a market that is quite expensive. You might think it's hard to find value in this market, but I think healthcare, energy, payment processors, there's a lot of interesting names there. I think there's still value on the table. And if you got value from this video, subscribe to the channel. If you want access to the website that I'm building out here or my template, my add-on that allows you to make spreadsheets like this, all you have to do is type in whatever ticker you're looking at over here and then hit load and it'll make a spreadsheet like this for you. So if you want access to this, check out my Patreon. Link is down below. If you try it out, you don't like it, let me know. I'll give you your money back. And if you agree or disagree with my thoughts on any of these sectors, let me know why down below. I want to hear, where do you see value in 2026? And wherever it is, I hope to see you all in another video.